An already volatile market feels even more so now, entering now a wartime environment. Our next guest has firsthand knowledge of global M&A volumes and deals in the pipeline. He spent nearly 30 years at Morgan Stanley before founding his own firm, which quickly grew into an industry power player. It is Paul Taubman, the founder, chairman, and CEO of PJT Partners. He joins me now exclusively to take a look at the big picture. Paul, thank you so much for joining today.
Great to be here, Dani. Thank you.
I have to say, your crystal ball has an excellent track record. Back in October, you were talking about maybe put the pom-poms away for the 2026 deals environment. Your most latest earnings, you said that, yes, there are overly optimistic bankers, but you have a more sober view of the world. Now we add in another geopolitical risk of war. What does your current sober view of the world look like?
Well, I don't think it's a sober view so much as it's a realistic view. You have to start with what's the baseline. The baseline is we came through 2025 record levels or near record levels of M&A activity, large deals, return of private equity. But the reality is we're dealing in a world of uncertainty, a lot of volatility, and we flagged two risks. One was geopolitical risk, and the other was AI disruption risk. And in our view of the world, those risks haven't been ignored, but they've been mispriced. And it was not that long ago that we were looking at a market meltdown approximately a year ago with the whole tariff issues and the uncertainties and the like. At the beginning of this year, Greenland surfaced as an issue. So when we think about all of the geopolitical hotspots, the idea that we're going to go through an entire year unscathed, I just don't think is realistic. And then there's a longer term trend, and most industry observers have been focusing on all of the stimulative effects of AI, all of the capital investment, the jobs, the demands for power, data centers and the like. But the reality is where there's creation over here, there's disruption. Destruction over here. And I don't think the market has fully appreciated that it's not necessarily a soft landing to get from all the growth and investment and world-changing capabilities of AI, but there's going to be a lot of roadkill left behind. And we're just seeing both of those in terms of the uncertainty about software, how to value it, terminal value, and we're dealing with a war where energy prices have spiked. All of a sudden, commodity costs are through the roof, and it's not exactly clear what the end game is. It'll clarify, but until it does, there's volatility, and as we all know, the biggest killer of M&A is volatility.
So maybe it's a market that's slowly coming around to where you were, and which was once a lonely view, but increasingly becoming more popular in terms of just this idea that deal making might slow down. Once the market does fully realize what you're talking about, what does that look like? What do M&A volumes end up looking like for 2026?
Well, it's hard to know exactly what they look like in 2026, but if you step back and take a long-term secular view, M&A activity should increase. It should increase because the world is speeding up. As the world speeds up, CEOs, boards of directors need to adapt. They need to respond. They need to respond more aggressively. They need to pair their portfolio, focus on core competencies. Scale matters increasingly. You need to onshore increasingly. You need to control your supply chains. So you'll see more vertical integration. You'll also see more horizontal consolidation in an effort to get to scale and have the financial wherewithal to make the AI investments. So if you take a long-term perspective, it should be up and to the right. And we are long-term bulls on M&A and M&A activity levels. Having said that, when you come off a year that is the second best in history and you're facing these big unknowns, it's hard to think that you immediately increase by 20, 30, 50%. And that was really the only sober caution that we have. When you get to a more stable environment, and there is less volatility, there's more price discovery, there's more appreciation and meeting of the minds between buyers and sellers, you'll see a meaningful return to M&A. But if we get to the $5 trillion mark, we're really in rarefied air. And I think there's a path for that to increase over time. But it's rarely in a straight line, and it's rarely just easily up and to the right. That's all we're flagging.
But considering that these are really big existential risks, AI and war itself too, are you concerned that that period, that window opening, that it gets further delayed or that it looks increasingly short?
Well, there's what we don't know are the tail risks, and what we don't know is there are all these unintended consequences once you engage in significant hostilities and you're seeing choke points in the supply and transport of energy and all of the ripple effects that have on the consumer, on the broader ecosystem, it's hard to know where things settle out. But ultimately, things do settle at a new equilibrium, and the underlying need to transact, is stronger than ever. So it's just a matter of time getting there. And I think what you're seeing in credit, what you're seeing with software valuations, is there was a base case, there were tail risks, and the tail risks weren't properly priced in. And every now and then, some of those tail risks look a little bit more like the base case or a somewhat likely case. And inevitably, all of that is going to work its way through the system. But right now, just to take software, when there is a world where no one really knows the long-term terminal value of many of these companies, and they haven't yet been able to figure out winners and those who are vulnerable, the price discovery process is very difficult. And you see that in credit, and you see it in equity valuations, and you see it in a lack of deals. But ultimately, the market returns to a new view, you get to a new equilibrium, and then we're back to the races.
Yeah, and to be fair, corporate America has been incredibly resilient over the past few years. Just on the point of AI, because it's not even just deal making, it's financial institutions themselves grappling with this technology. How are you thinking about use of AI at PJT? How's it being implemented?
Well, the first thing is we're not looking to shrink our workforce. What we want to do is want to make our best bankers more productive, better bankers, give better advice. So we start first and foremost with how can we use this as a tool to do more with what we have, not to do the same with less. We're still a growth firm. We're looking to continue to grow. We want to expand our geographic footprint, our product capabilities. So it's giving us deep insights into how to better advise clients. We've permissioned these tools for many of our senior bankers, and we're starting with our most senior bankers because that's where we believe you can get the greatest uplift in productivity and insights is by giving that to the most senior people. But you have to be very careful about how the information is accessed, how it's permissioned. Do you have the right backbone, the right capabilities? So we've been surveying, we've been innovating, but we've been cautious about exactly how best to implement all of this. But we have the luxury of being a smaller, more nimble firm where it's more of a game of offense for us than defense.
It's such a good point. So how does that change how you think of what LLM do you partner with? Are you partnering with an LLM? Do you try to bring it more in-house? How do those concerns about privacy, data, those things factor in?
Well, that has been the debate, and that's why we've moved slowly but methodically here. And if I look at all the decisions we would have made had we been forced to pick a path 6 or 9 months ago, they would have been the wrong path, the wrong direction. So what puts everyone ill at ease is you need to move quickly enough to be able to be on your front foot. But if you move too quickly in a world that's changing at such sonic speeds, you run the risk of headed down the wrong path. So it's how do you remain nimble? How do you constantly test every decision that you've made? And I think that's good for the organization to be on edge a little bit, but to see it as an opportunity to better serve clients and to not just be accepting that there's one panacea. There's going to be an evolution and a discovery process here. And that's why you need to put it in the hands of leaders first and followers second.
Well, one of the things that this market was also very excited about deal making is this environment of regulators, of a Trump administration coming in that's more business friendly. The administration has a lot on their hands, and one of the big things that they've been concerned about is affordability. I wonder how that impacts the regulatory environment, especially for consumer companies. Is this an administration that will be the M&A world is open, even if it is consumer-facing companies?
I think it's open for many, it's not open for all. So if you just step back and look at this administration, they have been incredibly pro-growth, pro-investment, pro-strengthening the economy and corporations. And you see that across the board in terms of cutting regulation, cutting red tape. That's all good. If you look at early terminations, HSR filings, there were 6, 7 of these back in 2024. It's like 400 early terminations in the first year of the Trump administration. So that direction of travel, incredibly positive. However, in a world where affordability is a cornerstone of this administration's economic policies, you have to believe that horizontal consolidation that creates the risk of price increases on consumer goods may be a no-fly zone. So I think it's productive for deals that should be done. They're not trying to frustrate deals across the board by just elongating every deal and just raising barriers. They're raising barriers where it makes sense to raise barriers, and hopefully they'll maintain those barriers on deals that shouldn't get done. So it's a much more constructive environment, but it's not an anything-goes environment.
All right, just got 30 seconds here, but are you seeing that in the market, that some of those companies that might have issues of affordability haven't gone fully forward with their deals?
It's certainly a consideration. I mean, every deal has to be looked at, sort of from the ground up. And instead of it being an automatic no, it's a possible yes. And then you have to ask yourself, what are you doing as far as bringing jobs back to this country? Investment. What are you doing to keep consumer prices down? And if you have a holistic package that's pro-growth and makes sense, you at least have an audience. That may not have been the case before.
Oh, this has been so brilliant. Thank you so much for joining. We really appreciate your time today. That is Paul Taubman, founder, chairman, and CEO of PJT Partners.